You've probably heard it 1,000 times. The Fibonacci golden zone is the ultimate tool to catch perfect reversals. But in reality, most of the time, price doesn't respect it at all. In this video, I'm going to reveal why your golden zone fails, how the market is actually moving behind the scenes, and how you can replace it with new Fibonacci settings that align with real price behavior, so you can stop losing trades and finally trade with precision. Please drop a like, subscribe, and turn on the notification bell so you never miss our upcoming content. Before we start, let's do a quick recap of what Fibonacci is. When price moves like this, let's say the move started at point A and ended at point B. This move becomes 100% between A and B. Now, when price starts a correction, it may retrace 20%, 30%, or even 80% of this move. To know where the correction may end, Fibonacci comes in to show the potential reversal points. The important levels are 0.382, 0.5, 0.618, and 0.786. If price reacts from the 0.5 level and starts following the trend again, that means the correction ended at 50% of the real move. So, when price makes a clear move, either up or down, traders will take the swing high and swing low and apply the Fibonacci retracement tool. The golden zone is simply the area between the 50% and 61.8% retracement levels. On the chart, it's usually highlighted as a shaded box or two horizontal lines. The theory is, if the market is trending, price will often retrace into this zone before continuing in the direction of the trend. But here's the problem. The market doesn't care about your golden zone. In ranging conditions, or when the swing points aren't clean, price can blow right through it, or reverse much earlier. And in many cases, the golden zone acts more like a ceiling than a turning point. If price hasn't gathered enough liquidity, or if the golden zone doesn't align with other confluences, such as a broken support, a trendline break, or a clear market structure shift, the market will often push below it to grab more liquidity before making the real move in the main trend direction. Here is a clear example of a failed golden zone. But why did it fail? We can easily identify a swing high and swing low, then apply the Fibonacci tool to mark the golden zone as a potential reversal area. However, if we enter long at this level, the stop loss will often be hit quickly. Here's the reason. In this case, the golden zone was positioned too high for buyers. Price was still considered expensive, and smart money or big players were not ready to enter their long positions. Instead, they pushed the market lower to collect more liquidity. Many traders rushed to buy from nearby order blocks and fair value gaps, yet most of them were stopped out. Only after a significant amount of liquidity had been collected was the market ready for the real move. Even though we could see demand zones and FVGs aligning with the golden zone, they still failed. Why? Because price was not yet attractive enough for market makers. The true reversal happened only after price reached a deeper discount, tapping into a lower FVG at much better prices. Now the expected point. Fibonacci custom levels. Let's apply these levels. 0.78 and 0.88. These levels are designed to give us better entry prices without needing extra confirmations, and they allow us to place buy or sell limit orders safely. These areas work well for buying at lower prices during an uptrend, and for selling at higher prices during a downtrend. The first step is to find a clear move, either an uptrend or a downtrend, without noise. Avoid ranging markets, because in sideways conditions, most tools and indicators will fail. Once we identify a clean swing high and swing low, we apply the Fibonacci tool with these custom levels. Then we simply wait for price to correct into these deeper zones and prepare for entry. As mentioned earlier, taking long positions while the market is still in the expensive area is one of the worst mistakes a trader can make. Even if the trade ends up winning, the risk-to-reward ratio will be very limited. After defining our area of interest, we can easily identify the major liquidity levels. These are the zones where many buyers attempt to enter, and where clusters of pending buy orders are usually waiting to be triggered. But instead of buying directly into these noisy levels, our approach is to remain patient and position our entries below them, where the probabilities are cleaner. For example, when a Fibonacci retracement level, aligns with a well-structured order block. In this case, our buy limit is placed at the 0.88 retracement level. One critical factor to keep in mind is spread. A single missed pip can cause the trade to be skipped, so precision matters. If price never reaches our level and instead moves higher without us, or dips lower and hits what would have been our stop loss, that's perfectly fine. The market will always provide fresh opportunities. Once price finally taps into our chosen zone, we enter the trade with the stop loss placed just below the area. The target is the buy-side liquidity. After some consolidation, price breaks out strongly and reaches our full take profit, completing the setup with accuracy and discipline. This is silver 4-hour chart. Price is moving within a clear uptrend, but recently failed to create a new high, building a strong resistance that signals a correction is underway. At the same time, a well-formed support zone is attracting retail traders to enter long positions. This is exactly where smart money knows you place your trades, and why we must think differently. These zones are not safe entries. They are liquidity pools filled with pending long and short orders. Once price breaks through, liquidity is taken. That's why our focus is lower. Our Fibonacci zone is perfectly placed beneath retail support, where real buying opportunities appear. Price reacted exactly as expected. Our pending orders were triggered at discounted levels, and take profit was reached within just a few candles. This is a short setup example. First, price made a change of character, choked, which signals that the uptrend may be ending soon. As we mentioned earlier, the safest way to place a short trade is after liquidity has been taken and stop losses are cleared. Keep in mind that at higher levels, price may not always reach your zones, so be flexible. You can also trade multiple pairs on higher time frames to find more opportunities. This way, there's no need to worry about missing a single setup. The risk-to-reward ratio is always favorable. One winning trade can easily cover 3 or 4 losses. In this example, the trade worked out perfectly and played out quickly. Remember, don't take Fibonacci levels blindly. Always wait for liquidity grabs, market structure shifts, and confirmations. If you follow these steps with discipline, this strategy can truly change your trading. That's the end of today's video. We always aim to provide you with clear and valuable content. Don't forget to like this video, subscribe, and follow us for more strategies and tips. See you in the next video, where we'll dive into how to use trading tools more professionally.